Welcome to The Explainer. Today, we're digging into the playbook for companies that are right on the edge of going public, and we're going to focus on the one thing that can absolutely make or break investor trust: governance. Okay, so let's just dive right in. When a company is getting ready for an IPO, the real challenge, it goes way beyond just the business model. When those big investors are looking at you, they really have one single massive question on their minds. And there it is. Seriously. The number one thing is that investors need to see a signal that your company is mature. And that signal, more than anything else, is rock-solid governance. It's what shows them you're not just a cool startup anymore, you're a serious organization ready for the big leagues. So in this explainer, we're going to break down exactly how you build that trust. We're going to look at how you can take what honestly feels like a compliance headache and turn it into your company's most powerful strategic advantage. Think about it. Your ability to talk clearly about risks, about your internal controls, and about how your board provides oversight, well, that can shape investor confidence just as much as your flashy new product. It's all about proving you've built a solid foundation, not just a pretty storefront. Okay, and this is where it gets really interesting. There's a huge difference between just being compliant and actually telling a compelling story. I mean, look, it's one thing to just list market risk as a line item in a report. It is a totally different thing to explain the exact board-level process you use to debate and handle that risk every single quarter. That's the story they're really listening for. And this just nails the point perfectly. An analysis from back in 2010 showed that while a huge company like BT Group ticked all the compliance boxes, the real award winners, companies like 3i, Aviva, and BAE, they went so much further. They didn't just list the rules, they explained their entire governance architecture, the how and the why behind it all. So you can really see the difference here, right? It's one thing to have a detailed risk section. It's another thing entirely to explain how managing risk is baked right into your company culture, from the very top all the way down. That's what builds real confidence. All right, so now that we get how important that governance story is, let's dive into a classic debate that really highlights different views on what good governance even looks like. And it all comes down to one question: who actually gets a seat in the boardroom? And you're not going to believe this, but this debate has been raging since the 1970s. A report in the UK first floated this idea of having worker directors on company boards, and it raises a really fundamental question: who is a company really supposed to serve? The people who are for it, they argue that having employees on the board is a massive asset. I mean, they bring these incredible insights from the front lines and push for a long-term view that goes way beyond just the next quarterly earnings report. But then, on the other side, the opponents, they worry about a pretty fundamental conflict of interest. They bring up real concerns about loyalty, about confidentiality, and whether adding that dynamic could actually weaken a board's ability to make tough, decisive calls for all the shareholders. So, while you don't really see formal worker directors in UK-listed companies, the spirit of this whole debate is actually more relevant than ever. Companies are now using things like workforce advisory panels or ESG oversight committees, that's environmental, social, and governance, to get that super important employee perspective, but without giving them a formal board seat. And that idea of balancing different perspectives, well, it leads us straight to one of the most critical governance decisions a founder-led company faces when they're going public: what to do about the chairman and the CEO roles. This is a huge one. Because while it might feel totally natural for a founder to hold both titles, you have to know that institutional investors have a very, very clear preference here. And that creates a major dilemma for a lot of companies as they get ready for their IPO. Yeah, from an investor's perspective, one person wearing both hats is a big red flag. Just think about it. If the company needs to make a huge strategic change, a truly independent board is there to challenge the CEO's thinking. But if the CEO is also the chairman running the meeting, that critical debate might just never happen. But look, if keeping both roles is just not negotiable for you, then you absolutely have to build a fortress of protections around it. That means having a board that's mostly independent directors and, this is crucial, appointing a strong senior independent director. You can think of this person as the leader of the independent board members, someone shareholders can talk to directly. You've got to prove you take oversight seriously. So let's tie this all together. The crucial point here is that all of these decisions about how you disclose things, about whose voice you listen to, about your leadership structure, they are not just about compliance. They are the actual building blocks of the story you're about to tell the market. By taking these steps, you're not just getting ready for an IPO, you're actually positioning your company as a mature, a responsible, and a totally credible organization. You are showing the world that you are absolutely ready for this next chapter.
And this quote just says it all, doesn't it? This is the ultimate takeaway. Strong governance is not a cost. It's not a burden. It is a powerful tool that unlocks capital and builds trust that will last. So as you get ready for your IPO, you have to ask yourself, are you just checking the boxes? Or are you building a governance story that will genuinely inspire investor confidence?